So I'm reading this piece on Zero Hedge. You know, that's the popular financial blog that pretty much is still stuck in the gold standard and Austrian economics, and it pretty much gets everything wrong. But I have to say, it's good on getting news scoops, and frequently it beats out some of the major news organizations. But if you think you're going to get any real financial insight out of Zero Hedge, then you're probably better off reading Mad Magazine. And just remember, web traffic does not necessarily equate to valuable information, just as TV ratings doesn't equate to real journalism, Fox News, or educational material. Jersey Shore, the Kardashians, you get my point. Anyway, there was a great post a guest post, I should say, on Zero Hedge today about the virtues of austerity from some guy at a hedge fund called Woodbine Capital. Turns out that Woodbine was some fund started up in 2008 by a couple of purported hot-handed money managers out of Soros. These guys raised something like $2.5 billion in a couple of months, but according to a story in the New York Post, they blew out everything with the exception of about $500 million, proving once again that most of these hedgies are good at raising money but not investing. And come to think of it, maybe it's because they're listening to this guy who's singing the praises of austerity in Zero Hedge. I mean, he's clearly out of paradigm. He says that the critics are wrong when they say that austerity depresses growth and pushes up debt. Okay, we'll leave that fact aside for a moment. But he goes on to say that they're missing the point. Austerity raises national savings, and with it, you get better credit market perceptions, and by corollary, better financing terms, more investment, more growth, etc. Now, this is once again the classic mistake made over and over and over again by the Austrians. The idea that you need savings first in order to drive investment. Now, Keynes said it was the other way around, but I'm not going to get into that. I'll just state that as a matter of accounting, savings equals investment. There's an equal sign in there. So all that means is for any level of savings, there is an equal level of investment, and for any level of investment, there's an equal level of savings. Which one comes first? Well, feel free to debate that for now, but I'm going to concentrate on austerity in the Eurozone, which is what this guy was talking about in his article. First of all, let's understand that the countries that use euro are functionally like states in the United States. They're not currency issuers, and therefore they're not non-sovereign, at least monetarily speaking. So we'll consider the countries in the Eurozone to be non-sovereign monetarily, which they are. So when you talk about increasing national savings in the Eurozone, there's only one entity, the sovereign that issues the currency, which is the ECB, that can do that. Only the ECB can increase the net amount of euro-denominated financial assets, just as only the United States government can increase the net amount of dollar-denominated financial assets. In the case of Greece or Spain or Italy or Ireland or any of the other countries this guy mentions, the savings of the government achieved through austerity is just a transfer of the savings of the non-government, in other words, of the people of Greece, for example. National savings have not changed one iota. It just got shifted from the people to the government. So yes, maybe the government has a little bit more money to spend and invest, but it comes at the expense of the people of Greece losing those savings. So no national increase in savings is achieved. Moreover, to the degree that austerity kills growth and raises unemployment, which it does, then savings in real terms actually declines. There's less investment, there's less real savings. As far as achieving better credit market terms, lower interest rates, and all that stuff, he gives absolutely no credit whatsoever to the ECB, which has been buying the bonds of these countries like crazy, producing, yes, savings. And that's the reason for the better terms. And by the way, in the example of Ireland that this guy uses as the successful model of austerity and how it should be done and how growth is resuming over there. Well, he conveniently forgets to state that Ireland is running record current account surpluses, which is a way of avoiding domestic private sector dissaving or the private sector going into debt. So there you go. Another out of paradigm analysis, another non-MMT hedge fund that blew up, and for good reason. They're a macro fund that has no clue about macro. That's it for now. This is Mike Norman saying bye-bye. See you next time.